Good afternoon and welcome to the Equifax Market Pulse Quarterly Trends webinar, where we're going to be focusing on what's been happening in the fourth quarter of 2022. For those of you who haven't met me before, my name is Becky Oakes and I'm the Vice President of Analytics here at Equifax. And I'm delighted that I'm joined today by two colleagues, Solomon Pandey, who heads up our Insight Analytics team, and Kathy Katsouleris, who is our Vice President of Consulting. Now, before we get started, I'm just going to hand over to Sandra, who's going to talk you through how the On24 platform works. Sandra.
Thanks, Becky, and good afternoon, everyone. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the slide area, so feel free to enter any questions you may have and we'll address them throughout our session today. In the event there's too many questions to get through, we'll generate an FAQ document which we'll send out to you in the coming weeks. Some related content is available for download in the related content area, and today's presentation in English and French will be available in the coming days. Our session is being recorded and you will receive the on-demand link via email also in the coming days. Some additional features you'll notice on the bottom of your screen are reactions, register now for our upcoming Commercial Business Trends webinar on March the 9th, a survey which will pop up at the end of the webinar, and contact us. Feel free to check any of these out and provide your feedback. Now let's get started. Becky, back to you.
Thank you so much, Sandra. So, as always, we're going to start off looking a little bit in terms of what's been happening on the economic side here in Canada. Now, as I'm sure it's no surprise, interest rates remains a big talking point. So the interest rate in Canada is currently sitting at 4.5%. And we've seen a kind of 8-step increase over the last year, which has really dramatically kind of driven those interest rates up. Now, we do have a policy interest rate announcement coming from the Bank of Canada tomorrow, and the general feeling in the marketplace is that it will most likely be held. And that's not to say that there won't be additional interest rate movements that could happen in the rest of the year. Now, when we look back historically, which is on the left-hand chart on the slide, this really still remains one of the biggest increase and fastest increases we've seen historically. And actually, we have to go back to the 90s to really start to see that rapid increase coming through. The current interest rate is sitting just about in line with 2007, 4.5%, and that, of course, was right before the banking crisis. Now, the main driver behind these interest rate changes, of course, has been the inflation. So that right-hand chart shows the overall inflation and shows a couple of the kind of key drivers behind that inflation. So it did fall in Q4, which is the good news. However, when you look at the green line on that right-hand chart, this represents the food inflation. And unfortunately, food is yet to start coming down. Now, that's a big challenge in terms of the everyday consumers because, of course, we all need to eat. Although we are seeing some movements in gasoline prices and transportation, and that's helping to bring down some of those interest rates, those essentials are still quite high. And, of course, that is going to have a knock-on impact in the ability for consumers to kind of purchase their day-to-day essentials and also into what happens in the credit space. Now, a bit of good news is when we start to look at things like disposable income, which we have on the left-hand chart. Now, this only goes back to Q3. This is actually Stats Canada that provides some of these numbers. Now, in the third quarter, we did see the seasonal increase across most of our kind of income bands. We often see that in Q3. The good news is that that is still higher than pre-pandemic. And we are kind of seeing some good disposable income levels still come through, particularly on some of those lower income ranges, which is the red line. When we look at the savings side, during the pandemic, we had increased savings, partly due to some of those government benefit programs that were coming through. That has now come down and it has stabilized. But again, some good news, which is going to help us as we move into 23 and kind of see what's happening this year, is that those saving levels are, again, a little bit higher than they were pre-pandemic. Now, some of that is still a little bit of the government benefits that are still coming through. And some of it is potentially just consumers being a bit more prudent in terms of their savings. Now, one of the big talking points was around, are we going into a recession? And that still remains kind of a lot of debate and a lot of conversation happening. Now, when we look at GDP for the back end of last year, the quarter overall for Q4, we were kind of flat when we look at GDP, but you will see that little downturn in December where it was negative for the first time. Now, again, there is some debate as to whether or not this is going to continue and how fast we might see a recession and potentially how significant that recession might be. The general feel right now is that Q1 might not be too bad, Q2, Q3, we are expecting that downturn to potentially kind of play a part in those quarters. But the general feel again is that it may not be as severe as some had feared if we go back a few months ago. And part of the reason behind why we think it may not be so severe is when we look at things like the employment situation here in Canada, which still remains really strong. So that right-hand chart, you'll see those grey bars, that is job vacancies, and they still are quite high. Unemployment rate is still, very, very low. And this obviously creates a reasonably good position for a recession if there is such a thing. So there is some good news coming through there. So in terms of all of these economic headwinds, as we're kind of calling them, that is starting to have an impact on the credit side of things, and we are starting to see some movements. So 3 themes that we're really going to be talking about today. First one is going to be rising debt levels. So we're going to go through where we're seeing that at a consumer and also at a product level. Credit cards are kind of a key driver in that, as well as some movements in terms of which consumers are actually starting to raise their balances. The mortgage market is going to be, again, a big talking point. I'm sure you've all seen the news reports around house sales and kind of house prices. So we're going to talk to you a bit around what's happening from the mortgage side. Unsurprisingly, there has been a bit of a downturn coming through there. And then finally, we're going to talk to you a bit more about what's happening in terms of financial stress. So, as we've had this high inflation period, interest rates are going up, the cost of borrowing is going up. There's a lot of focus in terms of what does this mean for consumers, and are we starting to see missed payments coming through? So we'll talk to you about where we're kind of seeing that start to happen. Now, when we look at overall total consumer debt, that ended Q4 at around $2.37 trillion. We did see mortgage and non-mortgage debt rise, although the mortgage side has definitely slowed down, and we'll talk about that in a bit later on. But if you look at that left-hand table, this is really breaking down where that non-mortgage debt rise has come from at a product level. So the biggest driver, again, credit cards, we saw that in Q3, that continued into Q4, and Q4 typically does start to be a period where consumers do spend more because obviously it's the holiday period. But when we compare to the prior year, we're seeing a 15.3% rise on those credit card balances, which is fairly significant. And for the first time, we've seen overall credit card debt exceed that $100 billion mark. Now, on a quarterly basis, that is also up because we do look at both of those measures. What we have added for you this time, you'll see in that final column on the left-hand side, we've actually added a seasonal estimate as to what we would expect normally pre-pandemic to see between quarters. And that's really important because certain products do have a lot of seasonality that comes through. So on the credit card side, we saw quarter on quarter rise around 2.6. Typically, we would expect to see 1.6. So again, it's a faster rise than we normally would be expecting. We also have seen HELOCs and kind of the unsecured lines of credit grow year on year. A little bit different in terms of HELOCs have picked a little bit faster than we would expect for Q4 compared to Q3. Normal unsecured line of credit is a little bit slower. And I guess one of the big talking points continues to be around the use of things like auto loans, where we know during the pandemic there was a lot of supply chain challenges that came through on the auto side, and we saw auto loan take-up slow down. That is, again, low again. Now, some of that still might be a little bit of hangover from the supply chain challenges, but actually some of this now is going to start to be impacted by those rising interest rates. So obviously the cost of borrowing is going up, and when we look at some of the auto loan interest rates that are being taken out on new loans that open, there's a big shift in terms of what's kind of happening on the auto side. On the mortgage side, on the right-hand side, what we've actually done is a little bit different this time. There has been a lot of talk about increased debt for millennials in particular. And when we talk about millennials here, we tend to talk around consumers who are around 27 to 42 years old right now. and we will talk a bit more on what's happening with them later on. But that right-hand side, you'll see on the mortgage side, although mortgage is slowing, there has been large increases for that group. So that's the group in the red bars. We have seen them take more and more mortgage debt. And it's not that surprising because, that kind of age range, 27 to 42, you do tend to be the most credit active in those those age ranges. And obviously you're buying your first home and you're buying property and things. So, those house prices are going to be impacted. But we have seen their mortgage balance in particular increase there. So what we do want to do today is a little bit different. We are going to break down the product level in a few minutes, but we also want to talk to you a bit about what's happening at a consumer level overall. Now, one of these interesting facts that came out at the end of 2021 was that Canada's population growth is incredibly fast. In fact, when you look at it across the G7, we're the fastest of the G7 in terms of our population growth. And during last year, we actually grew a lot faster. So if you look at that left-hand chart, this is the change in population volume that we see for Canada. And you'll see Q3 and Q4 in 2022 was, much, much higher than we've seen in the prior years. Now, of course, in 2020, we saw that slow down because of COVID and there was less movement, less immigration. But 2022, that has really, really picked back up again. So immigration has been a really key focus. When you look at the Canadian government, they have targets. I think it's 500,000 consumers they want to welcome via immigration by 2025 per year. So this is a significant population. We also had last year, of course, the Ukraine war and some of the impact that's had on additional individuals coming to Canada, obviously to escape kind of what's happening out in Europe. So Q3, Q4, our population growth was much, much higher than we've seen in prior years. Now, when we look at where some of this is coming from in terms of provincial, we do see the Maritimes seeing percentage-wise the biggest increase, but actually areas like Ontario, some of Quebec and BC, of course, they tend to be the provinces where a lot of these individuals first land as well. So we see from a volume standpoint, there's a lot of growth coming through in those provinces. Now, the reason this is so important is this actually is an important market for credit. As new immigrants come into Canada, they, of course, try and get themselves settled. They're going to need things like a mobile phone. They might need things like a credit card. And actually, we see a lot of credit activity starting to come through, in particular from these new immigrants. So it is an important growth sector. And I know Kathy is going to give some insights into that in a little bit. But when we look at kind of how these individuals use credit, in the first 6 months, and I say in the first 6 months, this is of when a credit file is first opened, and that could be from someone applying for credit or indeed managing to achieve credit. 60% of these individuals are taking a credit card and around 17% take a car loan. So, this is a very credit active population that's coming into our marketplace on a kind of monthly, annual basis. Second thing is, again, in the first 2 years of them being here, they're using over $10,000 of non-mortgage debt on average. So again, they're kind of taking a credit card, they're taking that car loan, they're actively using a lot of credit facilities. And interestingly, they actually aren't yet set up with a lot of loyalty, and some of that is due to the availability of products. Sometimes it can be a bit of a challenge, and we know that is a key area that as an organisation ourselves we're looking at in terms of how do we help these individuals and how do we help lenders make better decisions for these individuals. But they do tend to switch their products quite a lot across lenders. So we are seeing a lot of increase in credit activity, and that is partly driven by this huge volume of immigration that's coming into the country, but it's also been driven by the existing population here in Canada using credit more. So there are two drivers at play there. It's a combination of two things. So in 2022, we actually saw over 1.4 million new consumers becoming credit active. And credit active here means they have at least one open credit product. And when we look at where that's coming from a generational standpoint, that does tend to be more in the Gen Z millennial populations, which is partly, again, immigration, partly just new to credit consumers taking credit for the first time. But we are also seeing it has picked back up again on some of the older consumers as well, so your Gen X and your baby boomers as well. Now, if we look at the right-hand side, again, although we know that some of this increase in credit usage is coming from immigration, it is also existing consumers starting to use credit more as well. And again, we believe that is heavily linked to the inflation and cost of living. So on the right-hand chart, what we've done is break out non-mortgage debt into the age of the credit file. So this is kind of, what you can take from this is your blue bars there. They're really more than 2 years old. So these are established individuals living in Canada versus your grey and dark grey, which tend to be more new to credit, new to Canada. So we're seeing, both populations growing. We're seeing huge growth, as I just mentioned, almost 25% in terms of some of those new to credit, new to Canada populations. But we're also seeing, 5% growth as well for the existing population. So it's two things really driving those rises that we're seeing. So in terms of, if we switch a little bit and look at financial stress and financial difficulties, we are unfortunately starting to see delinquencies pick up again. They are on the rise. The good news is we are still not back to pre-pandemic levels, so they are still lower, which you can see on the right-hand side, the first couple of columns in that table. This is looking at this year versus last year in terms of Q4 2022 versus Q4 2021. And we're looking at both a dollar and volume delinquency measure there. So you can see almost all products are seeing a rise in delinquency levels with the exception of mortgage. But the last two columns in that table, that's compared to pre-pandemic. So we are still below those pre-pandemic levels. Now, one of the big talking points, of course, is the impact of interest rates and how that is going to start to come through and impact consumers. So we know there's a lot of focus on what does this mean for consumers with the mortgage, and there's been a lot of conversation around trigger rates and the payment shock that might happen for mortgage consumers. What we are seeing so far is that the biggest rise in delinquency is actually coming from the non-mortgage population. And when you think about it, it actually makes a lot of sense because where you have high inflation, higher cost of living, it does tend to take longer for that to impact individuals who perhaps have higher incomes, own their own home. We're waiting for the full effect of that interest rate change to come in versus lower income consumers, perhaps younger consumers who don't have as many savings, don't have as much support mechanisms in place. They are more likely in a high inflation, high cost environment to start missing their payments first. And that is what we're starting to see. So on that left-hand chart, you'll see the dark line there. That is consumers that don't have a mortgage versus the orange where they do. And that rise is picking up a bit faster for that non-mortgage group. And then finally, just to take a look again at the consumer level, linked to financial stress, when we move into severe financial stress and consumers becoming insolvent, we are seeing a continued increase on the consumer proposal side. So that red line on the left-hand chart, we are definitely getting back close to those pre-pandemic levels. Overall bankruptcy rate, though, is still remaining really low. So although proposals are being leveraged, and again, that's probably pockets of individuals who are becoming stressed during this period, the overall bankruptcy level is still down. When we look at this at an age group side of things, we are seeing a lot more increase coming through for the older consumers in particular. And again, this is something we saw back in 2018, 2019. I know we talk about that period a lot because that was the last period where we had interest rates rising fairly quickly. We did see this older age group be impacted a bit faster when it came to delinquencies and insolvencies. And that's partly because, when you get high inflation periods, if you are retired, potentially there's less ability for your income to increase. You also tend to have more usage of products like HELOCs, which tend to be variable rate. So they can be a lot more sensitive to those interest rate changes. So this is an early warning sign that we have been talking about for some time in terms of insolvencies do come through, and then you get the delinquencies and some of the kind of later lag factors. We are seeing that on those older consumers. So I'm going to take a quick pause there. I know, Kathy, this is something that you've been thinking a lot about in terms of what does all of this mean, all these changes on the consumer side, mean for clients? And maybe you could just take 5 minutes and maybe talk to us a bit about that.
Absolutely, Becky, and thank you. So here's where I'd like to really connect some of the dots in terms of what we just heard and what pockets of consumer segments lenders should be mindful of. So first thing is if you're looking for growth opportunities in terms of acquiring new customers, there's a significant opportunity to do this with the new to Canada immigrants. As we heard, immigration in 2022 saw a lot of newcomers coming into the country post-COVID. And this aligns with the federal government's aggressive plan to take in 500,000 immigrants a year until 2025. So that's really 1.5 million new consumers in the next 3 years. So this means new Canadians will be seeking credit as they settle down and establish themselves. And there's a huge opportunity to become their preferred lender or first card and wallet and create that journey for them to gain access to more credit as they build their loyal relationship with your institution. One key factor for more approvals with this segment will be looking to leverage alternative data to make better decisions. I'll call out that here at Equifax, we are very, very focused on helping facilitate that by bringing in new data sources like rental and utility data and incorporating them into new products. Next item I want to touch on is, again, given the economic conditions related to inflation and interest rates, we've seen how it's really impacted the cost of living. So there's been a lot of financial stress created, especially for consumers that have low income households, and they're really struggling to get by. So as a lender, it's going to be very important to be closely monitoring and identifying these pockets of consumers to understand if there's trends in their credit usage that's changed over time. Like, are they going into more debt? Has their utilization spiked? Has their payment behavior also changed? Is their ability to pay impacted, and do they have capacity? What does their cash flow situation look like? All very important questions. And these are the key triggers that you really need to be monitoring closely so that you can take immediate action before that slippery slope of delinquencies and insolvencies occur. Last segment I just want to touch on is the higher income population, or the pockets of consumers that have higher income. You normally assume that they're in better financial positions because they've got high credit scores and they can better weather a storm related to the higher cost of living. But this pocket of higher income consumers also probably have higher significant exposure to variable rate products like mortgages or HELOCs, and maybe at risk at experiencing that financial stress upon renewal time because of the higher interest rates that we have now. So as a lender, again, very important to be looking at these early warning signs through a monitoring program that's going to alert you if, again, debt levels and payment amount behavior start to change and where their capacity to pay is impacted. Again, identifying the most vulnerable, it's going to allow you to be proactive to mitigate the risk and allow you to work with your customers to support them through their financial struggle. So on that note, I'm just going to pass it back to Becky to see if we've got any questions from our audience.
Thank you so much, Kathy. So yes, we did have a question came through on delinquency rates. I've seen other data that shows delinquencies on installment loans are now above 2019 levels. This is slightly different to what we're showing here. Any idea of what the difference is? So a couple of things. So it depends. There's a lot of movement right now. It depends exactly on which time period you are comparing to. So what I've just been talking through was around 30 plus, which is basically a consumer has missed one payment or more on a particular product. I think if you look at the 90 plus, which is more severe financial delinquency, it is much closer to 2019 levels, in particular on some products like the auto side, where it's kind of auto captives is what we call it. But I think Swanema is going to be talking about that in some sections coming up. So I think it's just a little bit different in terms of definitions, but we will get to kind of what's happening at that more severe financial delinquency at a product level in a little bit. And I think that's the only question we've had so far. So please do use the Q&A, ask us some questions because we do love to hear from you. So Swanima, do you want to maybe move on and talk to us a bit about what's happening on the cards portfolio?
Sure. Thanks, Kathy and Becky, for giving an overview of the credit growth and performance at a consumer level. Now, let's deep dive into each of the product segments. So first up is credit cards. Credit card growth has been strong all through 2022, and a lot of it was driven by new originations. Over 1.4 million cards were issued just in the last quarter of 2022 and even in the quarter before, which is a big jump from 2021. As Becky explained, the growth contribution is by both new to credit as well as existing consumers in need of credit. To understand the actual source of demand, we have split the change in new card originations by new to credit or country. So consumers with credit file age less than or equal to 24 months and consumers who have been credit active for more than 24 months. So the first bar compares year-over-year change, and the second gray and blue bar is a comparison from pre-pandemic. Not surprising that majority of the credit card originations are coming from younger consumers, mostly new to credit, and have even surpassed pre-pandemic levels. But overall demand, if you see, for credit cards is high across all consumer segments, especially when you compare it to 12 months ago. We are also seeing a high credit demand coming from seniors, 65 plus consumer segment, which is highest among the existing consumer group. This could be early signs of financial stress as we are seeing a higher number of insolvencies for this group. Now, moving our focus from new volume to credit limits on new cards, we see that the average credit limit on new cards is over $5,000 as of this quarter. And it has gone up for all consumer segments, even across lower score bands, even though their average credit limit is lower, but the increase is substantial. It shows the shift in the credit card market, where lenders are assigning higher credit limit at acquisition for even slightly riskier consumers. The growth in credit card is not limited to new origins. There has been a jump in average credit card spending per credit card consumer. And we have been seeing that since the end of 2021. The gap between average credit card spending in 2022 versus previous years is very stark. And if you see the blue dot in the left chart, it shows the average spending for Jan 2023, which is already way above Jan 2022. So we are starting off at a higher average credit limit, credit spending this year. So higher demand and higher credit usage, increasing cost of living is contributing to the increase in spending. The good news is that the average payment paid by consumers on their credit cards have also been going up along with their spending. So the right chart shows that a huge portion of spending is driven by transactors. So consumers who are paying their credit card balance in full. The solid line here is average spending, while the dotted line is the average payment. Now, spend on revolvers, consumers who are paying less than 90% of their balance, is much smaller, but the gap between their payment and spending is more visible now. It's reverting to the pre-pandemic levels. Increase in credit card revolving behavior also translate into higher missed payments. So now taking a look at the vintage delinquency rates of account opened from 2018 to 2022, we see that the newer accounts opened in 2022 have started to miss payments after 6 months of opening. And that increase is more prominent in consumers 35 years of age or under. Another group that comes through for higher delinquencies is delinquency rates for 55 plus consumers. So although the delinquency rate is lower than average, it is still rising at a faster rate. Another performance measure that we usually that we have been tracking for a while is transacting behavior, especially for consumers who have a variable rate product like a home equity line of credit. In the past, we have observed that during high interest rate periods, consumers with a HELOC can find it difficult to keep up their payments. As you can see in the chart on the right, we saw a bigger than average drop in transacting consumers who had a balance on their HELOC in 2017. And a similar trend is now visible where HELOC consumers with a balance are starting to revolve on their credit cards faster than other consumers. We also took a closer look at credit card payment triggers, which are basically a great indicator for early identification of rising financial stress. We looked at 12 months of payment history to split consumers in 4 groups. So someone who has been paying for all 12 months is a true transactor. Someone who has missed payments for revolved payments for 6 months is a frequent revolver. Less than 6 months is occasional, and someone who has revolved their credit card balance for all 12 months is a regular revolver. So compared to 1 year ago, we do see more consumers are falling in regular or frequent revolver categories, especially, again, consumers under the age of 35 years of age or under. And overall credit users went up by 3% year over year, but regular and frequent revolvers went up by 5 and 4%. So we are seeing more transactors are slowly switching to revolving behavior. And financial stress is now more visible than ever, especially when compared to last year. But there's also some growth opportunities. To better understand if there's a way to strike a balance in credit card space, I'll hand over the slides to Kathy now.
Perfect. Thank you, Swarnima. So just to help recap what we heard, we saw that credit card demand has spiked up with a good portion of the demand coming from the millennials. And where new cards have been issued, there's higher credit limits being offered. From a usage perspective, the average spend on those cards have gone up, but the payment behaviors are starting to change and slow down. Again, there's early signs of those transactors becoming revolvers, as we just heard from Swarnima, and delinquencies beginning to increase, especially for the newer vintages. So if you're a credit card lender, what does this mean to you and what should you be thinking about? From a growth opportunity perspective, there's definitely a market for new customers, both from immigration, as we talked about earlier, and also that younger demographic new to credit. Acquiring these new customers really opens the door to becoming their preferred lender if that relationship is nurtured in their credit journey and staying really close to them. It will ensure that you've got an opportunity to sort of monitor their credit behavior and really see sort of how you nurture that relationship. From a risk and collections perspective, again, offering up a higher credit limit to new customers as a way to get the consumers to accept your offer. In this competitive market, it does introduce higher exposure to the lender, but it's important that your adjudication strategies are also assessing that consumer's capacity to take on that credit. So as we saw with credit card usage increasing, and where payment rates are decreasing, early stage delinquency is going to lead to late stage delinquency. And if you're not closely monitoring your customer base and segmenting out who you need to take action with sooner, you need to really look to find ways to minimize your losses and see where you can recover as early as possible. Let's switch now actually into some automotive gears and pass it back to Swarnima to hear about the auto industry.
Thanks, Kathy. We'll discuss auto in 2 parts. First part will be auto loans from captives, the non-bank lender, and second part will focus on the bank auto loans. So overall, auto growth has been very volatile owing to the supply chain issues that the industry faced. And as these issues are getting resolved, we are seeing an increase in new auto originations. Now, new auto loans are up from last year, but auto leases continue to slow down. There are 2 things at play when it comes to new auto originations. First, the pace at which the average auto loan was increasing has slowed down, but the car prices are still substantially higher than pre-pandemic. Second, the high cost of borrowing is reducing affordability for many consumers. While new auto loans are not growing as fast as expected due to higher interest rates, higher car prices, it's the leasing activity that most impacted. So current economic situation is taking over the advantage that leasing normally has over loans, turning consumers away from auto leasing. We are also seeing a huge increase in auto delinquencies, and especially auto loans, which are almost back to pre-pandemic levels. So the chart on the left shows both balance as well as volume level delinquency. And the bigger increase is visible in 90+ trade level delinquencies, as dollar delinquencies are being masked by the high rise in auto loan amounts. Now, moving to the chart on the right, we again have a vintage chart that shows how quickly or newer auto loans that were opened in 2020 are starting to miss payments after 6 months of being open. And again, we are seeing consumers 35 years of age or under are again at a higher risk of missing these payments. Switching gears to bank auto loans, we are seeing a similar slowdown in average loan amounts, especially for used car. As you can see from the chart, used car amounts jumped dramatically up from 2021 and has been increasing, but finally we are starting to see a slowdown in used car prices, and hence the average loan amounts are reducing. But as discussed before, the drop in car prices is being offset by an increase in interest rates. So chart on the right shows new originations across interest rate groups, and we can clearly see the shift in rate groups from loans that originated for less than 5% interest, and now that has moved to over 5%, which is a big shift. And this has a bigger impact on used car loans, as delinquencies for used car is fast approaching 2019 level, though we are not seeing the same for new cars. And higher used car loan amounts has also extended the amortization terms for these loans. And extended terms, while extended term help reduce the monthly payment obligations for some consumers, a lot of the delinquencies are coming from the short-term loans, which are facing difficulty with higher payments due to higher interest rates and have started to miss payments. So lots of changes in auto industry. Let's find out how to navigate through them. Kathy, over to you.
Thanks, Swarnima. So again, I really like to recap sort of what we just heard to make sure sort of we're all following along. So we've got the supply chain issues that have improved, but loans with the higher interest rates are still impacting new vehicle sales. For the used car loans with shorter terms that were open during COVID, we're starting to see some early signs of delinquency. So that's your baseline. Putting that into perspective, again, if you're a lender in this space, what does this mean to you and what should you be really thinking about? So I'll start off with the growth perspective again. Given that the correction on the supply side, many consumers are actually that were holding off on buying a new vehicle or didn't want to pay for an overpriced used vehicle, they started their car shopping now, especially since prices have normalized. A good sign of this is at the Toronto Car Show a few weeks back, they said that more than 350,000 people attended, and it ranked the third highest in attendance in the event's last 50 years. So clearly a good indicator that shopping has resumed. So as a lender, it's going to be very important, again, to be sort of looking at your adjudication strategies, making sure that they're refined and equipped to really understand the consumer's financial position and their capacity to take on a new loan, especially with the higher cost of borrowing. And of course, from there, stay close, because as we saw, new car sale vintages are more at risk of going delinquent. From a risk and collections perspective, again, that pocket of customers that did buy a used car with the inflated prices, very important that you're monitoring them. Given that the asset, as the asset actually depreciates in value, they might end up having a loan that's higher in value than the asset is actually worth. So again, must be proactive in terms of monitoring your customer base, looking for signs of stress in terms of changing behavior. And to do this, it means getting the latest information you can on your customer as part of a 360-degree view. Last thing, make sure your collection and recovery strategies have been reviewed and are optimized to ensure that if there is an influx of accounts that are defaulting, you're in a position to minimize your losses. So on that note, let's move away from auto and let's dive into what's been happening with the mortgage market. So Swarnima, back over to you.
Sorry, so moving on to everyone's favorite sub-segment, mortgages. Now, rising interest rates have had a ripple effect on the industry, affecting every aspect of mortgages, First impact is obviously on the new originations, which have really slowed down. As you can see in the chart on the left, it's the lowest since Q1 2019, and we are finally seeing mortgage loan amounts dropping from the peak. Increasing rates have had the biggest factor in slowing down the mortgage frenzy, and we see the biggest drop in new originations coming from the hottest markets like Toronto and Vancouver, where the new originations dropped by over 40%. But the good news is that we are also seeing pricing correction, as average loan amount for Toronto and Vancouver dropped by 9% and 7% respectively, and we are seeing loan amounts drop across all provinces. So definitely there's some price correction happening in the market. Now, second impact is on the first-time home buyers. First-time home buyers are in a time period where interest rates are extremely high with very little correction in house prices. So the biggest roadblock with high interest rate becomes the monthly payment obligation. So in 2021, even with higher loan amounts, first-time home buyers had smaller monthly payments. But in 2022, their payments have shot up for the same loan amount. The chart on the slide shows average monthly payments of first-time home buyers from different provinces, along with the increase from the pre-pandemic period. Overall, first-time home buyers are paying almost over $800 more than first-time home buyers in 2019. The increase is much more substantial for Ontario and BC, where payments have increased over $1,000. And while a slowing housing market can be beneficial for some first-time home buyers, since the prices are stabilizing, less competition in the market, but yet it's not a complete buyer's market. And we might see some reduction in first-time home buyer volume after the new changes proposed by OSFI takes place. It's going to impact first-time home buyers who will need lower loan-to-income ratio to qualify for mortgages, as lenders will be restricting the number of high LTI mortgages they can offer. And we have seen a rapid shift in higher LTI loans as house prices started to increase from mid-2020, but household income levels did not see the same increase. So changes in the housing market are not just limited to first-time home buyers. Interest rates are up by 425 basis points in the last 11 months, which reduced all kinds of mortgage activity. We saw, like in 2021, there was an increase in investment property purchases. More consumers were taking on multiple mortgages, but all that has slowed down again in 2022, and there's a drop in new property purchases. While lower interest rates in 2021 triggered a lot of refinancing, but now due to high rates, refinancing is the biggest contributor in lowering the new mortgage originations. Another impact on the mortgage market, which is slightly from the mortgages, from the lowering for mortgage originations, as well as the pandemic, because is the intercity migration. So pandemic induced a lifestyle shift with most people working from home. This was the time we saw an increase in new mortgage originations with people moving away from big cities to suburbs or smaller cities. But as mortgages take-ups are slowing down, offices have opened, employees have to get back to work, the movement between cities have also slowed down. So the table on the right shows the percentage of consumers moving out of these cities when they were taking new mortgages. And as you can see, the increase is much higher for 2020 and 2021. And in 2022, it has slowed down, and it is most likely to drop and reach similar levels as 2019. Now, let's look at the impact of interest rates on existing mortgages. We have already discussed in our last webinar how fixed variable rate mortgages are hitting trigger rate, which is the interest rate at which a consumer ends up paying just interest and no principal. And lenders are intervening and helping consumers not to reach a negative amortization. But there is another segment for which higher rates are very concerning. And these are consumers who are up for mortgage renewal in 2023. The table shows how fixed rate mortgages, which are up for renewal, will be impacted due to high rates. So depending on how much outstanding balance you have, your payment will increase accordingly. Rates are almost, if I compare it to 2018, it's almost up 200 basis points. And payment could rise as much as $900 or $1,000 for consumers with higher balances. So consumers must prepare to accommodate this payment shock in their monthly expenses. So Kathy, is the mortgage market all doom and gloom, or is there a silver lining somewhere?
Very good question, Swarnima. So again, before I address that, I just want to do a short little recap on what we've just heard. So, as much as nobody likes that the interest rates were hiked last year, they did seem to cool off that hot, out of control housing market. And unfortunately, it's made it more difficult for the first-time home buyers trying to get in. On the flip side, though, those that are already in the market and have a renewal coming up, they're also in for a payment shock, given the significant amount of these consumers currently have a fixed mortgage rate, and they never went through a stress test requirement. So what does this mean? If you're a lender in the mortgage space, what should you be thinking about? So for starters, a cooled off market really means that there's less homes up for sale, resulting in a mortgage market slowdown. So higher interest rates are going to make consumers very price sensitive, leading to shopping around for that best mortgage rate. Or in other cases, that higher interest rate will make it more difficult for a home buyer to qualify, especially after a stress test, or as speculated, the new OSFI guidelines coming later this year. So where there is an opportunity for new growth, you're going to need to make sure as a lender that, it's market competitive and attractive to the buyer. But on the flip side, you're going to need to make sure that you have refined your policies to ensure that you're looking at all debt and payment levels for that consumer over time. And again, do they have that capacity to take on a net new mortgage payment? Once on the books, as usual, again, my message throughout this webinar has been, all about closely monitoring credit activity and behavioral changes will be critical. From a risk perspective, renewals are going to need to be reviewed carefully to fully understand that consumers' current financial position and their ability and capacity to take on a monthly payment increase. Again, renewal time, that consumer who's very price sensitive is also going to be exploring other market options, which make it very important that there's a proactive approach in place to reach out to that existing customer and start that renewal process a bit earlier. For the pocket of consumers that are carrying a variable rate mortgage and that have hit or are close to their trigger rate, their monthly payment has increased or where negative amortization has been occurring. It's also critical that that consumer's financial position is closely monitored. It's going to be very important to see if other loans have been paid off, if, again, there's excess cash flow to cover off any increase for that mortgage payment or any other mounting debt. Are there other unsecured payment rates going down as well? Again, you got to look at the big picture with that consumer and basically analyze and segment your population, using payment information made against obligations to really rank order where you're going to have those pockets of risk. So on that note, I think we've accumulated quite a few questions, so I'm going to pass it back to Becky to take us through some of those.
Fantastic. Thank you, Swarnima and Kathy, for that. So let's go through some of these questions. Swarnima, were there a few from my section?
Yes. So one question is given that Equifax is based in various countries for immigrants, is it possible to fetch credit scores for new migrants from their home countries or even abroad from their home countries? And that might help lenders onboard these customers earlier and help their credit journey as well.
Yeah, that's a great question. And actually, this is a real key focus area for Equifax right now. So we do absolutely see that this is a huge market that is growing. That's really important to lenders. It's really important to the economy. So we are looking at multiple different ways to start thinking about how we help lenders with their decisioning. So to address that particular question in terms of credit scores from other regions, so we are actively looking at the potential to not only look at scores from other regions, but also some of the information from other regions. It sounds much simpler than it is. And the reason I say that is that obviously needs to be, we need to be able to get access to the address in both countries. Obviously, we need to have a bureau within that country, and some of the biggest immigration areas coming into Canada right now, that can be a little bit more challenging. There also are differences between scores and how they're used in other geographies, and also some of the types of data that goes into some of the information they have. So it's great question. It is something we are definitely actively looking at. It seems simpler than it actually is, but we definitely are working on that. And I think what I would say as well is, there are other ways to start thinking about some of these new to credit, new to Canada consumers as well. So we are actively looking at things like different alternative data and starting to test and trial and understand how can other data points be used to help lenders with decisioning. Rental's one that we talk about a lot in terms of, one of the first things you do when you land in Canada is you're going to need somewhere to live. So actually understanding rental payments, how you perform on those, that could be something that's incredibly useful for this population. So great question. It's something we are definitely actively working on. And I'm pretty sure there'll be a lot more coming out on that this year from Equifax. Anything else on that in terms of my section?
Yes, so there are two similar questions around new to credit demand. One is it generated by the pent-up demand as immigration landing paused during COVID? And another is how much of the new to credit is coming from immigration and coming from existing consumers?
Yeah, so it's not a perfect, we don't have a perfect way to properly split out new to credit and new to Canada. For some of those populations, they overlap quite a lot. So if you think about students coming into Canada, obviously, they tend to be a bit younger. They tend to look very similar to other new to credit, populations of that age group. Where we are able to split out a little bit is where we start looking at some of the older populations. So we do have some models that we look at in terms of, estimating which are new to Canada, which are new to credit. There definitely is an increase in both, is kind of what we would say from our models. So the new to Canada, again, if you go back to one of those earlier slides in the deck, the population growth, particularly in the back end of 2022, was quite significant. And a lot of that is coming from immigration and it is coming from refugees and things from Ukraine. So there definitely is both impacting our overall credit usage right now. But yeah, it's not a perfect way that we can split it out, but it is both. Anything else on my section? If not, I can ask you a question.
No, yeah, I think there are a lot from my section, yes.
Okay, so there was a question, can you comment on fraud trends? I don't know if you have any information on that you can share.
Yes, so I think we talked about it in our fraud webinar as well. We are seeing fraud rates rise. And since the mortgages have slowed down, so we are not seeing a huge increase in mortgage application fraud rates. But when you look at credit cards and mostly unsecured lending, that's where we are seeing a big increase in fraud rates, especially identity fraud for credit cards. There are a lot of targeted fraud attacks for credit card applications, especially identity fraud, and that's where we are seeing the maximum increase. We have also seen an increase in deposit fraud, not as high as what we saw in 2021 when we had a lot of new deposit accounts being opened. But yes, fraud rates are increasing. For a lot of things, they're not as close to 2019 levels, but for credit cards and other unsecured lending, we are seeing them reach very close to pre-pandemic levels.
Okay, fantastic. In terms of credit card delinquency and some of those missed payments, do we see any differences across provinces? For example, Quebec versus Ontario versus BC. Are we seeing any provinces that are particularly worse than others for that delinquency that's coming through? So
overall, it's up across the country. It's up across all provinces, especially not close to pre-pandemic, but definitely up year over year. A big increase is in Ontario and BC, followed by Alberta and some of the Atlantic provinces. So we are seeing that increase across all provinces. Okay.
There was a question, I don't think we can answer this for Canada, but I know we certainly probably can from the global team that we work with. So there's a question around, do we have any data that looks at the liquidation of deposits, investment products to help pay down loans, whether they're stolen through this challenging period? So I think the UK has some of that, Swanam. Is that correct? I think they actively look at that.
Yes, they are seeing that a lot of people are moving, so they have access to deposit and checking, so they are seeing a lot of people moving their money from deposits account to pay their, from savings to actually pay off their credit card or other loans. And they are also seeing a rise in buy now, pay later and the credit card lending in general. So more people the credit demand is increasing across the globe, and a lot of people are seeing that shift from savings to actually spending.
Yeah, and what I would say, I know we haven't really got too many global insights in this quarter's webinar just because we had too much to go through. But we do have on the Equifax website, there is a global paper that we issue every quarter now, which has some really interesting facts around what's happening globally. And actually, as Swanama mentioned, we're generally seeing the same thing in many, many regions. So if the UK is seeing this, I absolutely imagine it's happening here in the same way in terms of leveraging those savings and kind of other investment products to kind of help through this period. Okay, let's see what else we've got. There was a question around, let me just find it. Are we seeing a shift in the percentage of insolvencies coming from pre-delinquent and delinquent populations? So I don't know if we've looked at that recently. I know that's something we've definitely looked at in the past.
So yes, in the past we have seen that, like right before the pandemic, we saw that divergence between delinquency and insolvency. So a lot of people were going insolvent without going delinquent. So we were tagging that as a surprise insolvency. And we are seeing right now as well that the insolvency rates, especially not the bankruptcy, the consumer proposal rates are increased at a much higher pace than the delinquency. So it is safe to say that, yes, I'm sure a lot of consumers are opting for consumer proposals instead of missing payments on the credit products. But bankruptcy uptake is still very low.
Okay. So Kathy, one for you maybe, I'll put you on the spot. Do you believe the government might adjust the stress test to help first-time home buyers? That's a great question. Any thoughts?
That is a tough question. And I think just given sort of the interest rate hikes, there's that 2% sort of buffer. Increasing that to even more, difficult to say what to predict with the government. I don't think in the short term they're going to be looking to adjust that. That's my personal belief. Obviously, they're going to be closely monitoring it. They're going to be looking at perhaps other type of sort of guidelines to introduce. Again, they really want to make sure the mortgage market stays cool. So for now, I think they're probably going to stay put. They're not going to touch that.
Okay. There was a question, I don't know, Swanama, maybe this is for you, or maybe I can have a go at this one. Is the gap between payments made and balances due, as well as delinquencies for credit cards, increasing across credit score bands? Are we seeing performance deteriorate for high score segments as well? I think, the challenge with credit score bands is as a consumer's behavior starts to change and starts to kind of show early warning signs, the scores naturally should adjust at the same time. That's kind of, one of the great things about credit scores is that it gives you a real-time view of kind of what that potential risk is. So your credit score bands will start to drop as your utilization goes up, as your payments come down. In terms of kind of that kind of gap between the payments made and balances, I think as Swanama, you mentioned, we are seeing revolve rates are increasing. So that's the percentage of consumers who are not paying off their credit card balance in full. And that does tend to be an early warning sign in terms of financial stress. I think what we're also seeing is, this is, although a lot of it is overall across the board, all credit scores, we're seeing balances go up, we're seeing different things happen. What we're really starting to see are pockets starting to come through where kind of that spend to payment ratio is kind of really starting to separate. So the spend is far exceeding the payments that they're able to make, and their pay rate effectively on those credit cards is starting to come down. So, this isn't a doom and gloom for everybody. It's more there are some consumers who are better equipped than others right now to be able to manage through this current period. And what we do see there are pockets, and as kind of Kathy's talked to a little bit earlier on as well, that's why it's so important to be looking at your portfolios from a segmented viewpoint. So I am very conscious we are almost out of time, and we had a lot of questions come through today. I think we had close to 40 questions. So I do apologise if we haven't got to your questions. We absolutely will try and follow up with a FAQ after this session, and we'll try and get some of those answered for you if we didn't get to them. One thing I will call out is there was a question linked to business. So what I will say is that you are in luck because we do have our business webinar happening this week on Thursday at 1 p.m. So if you do have any questions around the small business side and kind of what some of these interest rate movements mean for small businesses, what's happening with some of those trends, because it is really important, it links to consumer as well. There's a lot of employment from small businesses in Canada. Please do attend that webinar on March 9th at 1 p.m. There's a great couple of speakers going to be doing that. And I think you can register somewhere on the On24 platform as well. Apart from that, I just want to say a huge thank you for joining us for this quarter's session. I hope you will join us for our Q1 session, which will be in a couple of months' time. And apart from that, have a great day.